Good morning, ladies and gentlemen. Today is the 10th of May, and we are filming this in the first hours of the morning, just immediately after the Chinese delegation apparently walked out of the talks with Besant in Geneva, which is never a good sign. So the over the weekend betting markets are indicating that we're going to open somewhere around 1% lower in equities and 1% higher in the risk off currencies like the yen and the Swissy. So, irrespective of how far down we go, we are talking about a risk off move, which is going to dominate Monday and Tuesday. Just wanted to give you that information, but let's discuss first what happened last week and what we think is in store for next week. Andy, do you want to kick us off and tell us what you thought of the price action last week, which was fairly uninspiring because really nothing moved very much. Equities, what? They closed down 0.25% on the indices and the bonds were up 5 basis points. So really nothing that indicated what asset prices should reflect. And that's maybe what we need to concentrate this week on.
Sure. So yeah, you recapped what happened. There was a FOMC meeting.
Right.
I would say, people want to define the outcome in a simple word, hawkish or dovish. My view is going in, a very dovish outcome was impossible. And we said this in our last conversation. Very dovish was very unlikely. Very hawkish was very unlikely. And really, we were going to be in this very, very narrow range of mildly dovish to neutral. I would say it was on the hawkish side of neutral, but, now we're talking about very, very narrow shades of gray. The big takeaway was they don't know. They don't know whether growth is going to fall rapidly, hitting employment due to policy and the ongoing economic outcomes, nor do they know whether inflation is going to go. Well, they are fairly confident we're going to see a short-term inflationary burst, but they don't know how much, when it happens, nor how long it persists. They're on hold. And I think so. What I noticed in terms of price action was, I think sometime middle of last week, maybe it was early this recent week, there was as many as four-ish cuts priced into 2025 and 5 or 6 into, the next, before we hit a terminal rate of close to 2.9%. That really reversed. We ended the week with June coming mostly off the table and 2025 falling to 33, about 66 basis points of cuts, which is less than 3. I think that's probably an opportunity, given our outlook that the Trump policies are anti-growth, and we go into that when we talk about next week. There's a good chance the economy slows down enough so that the Fed has to cut maybe as much as 50 and probably as much as 50 on the first cut. And that could be July, it could be September, but it's coming. And so, that's probably the thing that sticks out in my mind, but it's hard to trade for an unlevered account.
Absolutely. No, what struck me in the FOMC meeting is that he emphasized that he will be looking at the speed, at the rate of change of the employment data. So he's really looking for an acceleration of unemployment to give him the timing for the cut. Now, when is that likely to happen? When can we first see it? Well, we've been fairly consistent in saying that the real data is unlikely to deteriorate until we hit a window of late May to early June. And then we can see the repercussions of the Trump tariffs in the real data, and not before then. And I think that what he made fairly clear is another thing that we've been saying for a while, and you've just mentioned, and that is that when they do see that acceleration of unemployment, they will know that they are way behind the curve. And therefore, the odds of them moving by 25 basis points have to be less than the odds of them moving by 50 or more. I think that the real reason why they are on hold is because they can afford to be on hold. Real rates are neither high nor low. Real rates on 10-year notes are just over 2%, and therefore they are neither at levels where we would be real buyers, i.e. at 275 or 3%, nor are they at levels around, sort of 155 or lower, where we would not be interested in buying bonds at all. So they have what they consider a mildly restrictive policy at four, let's call it 4.25, and they can afford to cut very rapidly down towards zero Fed funds real rates, i.e. if you say that inflation is roughly 2.5%, they can take Fed funds very quickly down to zero, i.e. to 250, and really stimulate the economy and slow down the rate of unemployment change. So they are comfortable at this level simply because A, they don't know, but B, they have a lot of room to cut should they need to be able to cut. So for the time being, they're on hold, and that's all we can say. We still think, I think both of us, Andy, that the first move that the Fed is going to do, without going into when they're going to do it, is going to be a cut. And if it's a cut, it's going to be a big cut rather than a small cut.
Yeah. So moving into next week, as Nick said a few hours ago, there was rumors which have yet to be confirmed exactly what's happening in the trade talks, that they could have broken down completely, or the participants could have separately left the hotel for lunch. It's sort
in Beijing.
It's sort of irrelevant for anything but very short-term trading. Let's just frame where we think things come down. The UK did a deal, sort of, in that there are no actual laws that were created, or even the trade deal itself has yet to be inked in any way, official or unofficial. But they're paying 10% plus some other things. And
this is the biggest ally.
And this is our biggest ally. So I wouldn't want to place too much emphasis on that 10%, because if for some reason the Trump administration needs to give somebody else 5%, they can always go back to the UK and say, yeah, we'll cut 5% from you too. So I don't want to overstate how this deal that's, again, just on paper, creates a benchmark for all future deals, but I think it does. And again, not something that's set in stone, but it does. And when you look at China and the objective from, both Trump terms, certainly his 2024 campaign and everything he said, tariffs are going up in China. They're going up around the world. And when you add up the tariffs, it's a meaningful tax on the American economy and should have a meaningful impact on GDP, which is good for bonds and bad for stocks. And we're also looking at immigration, which is a very, a centerpiece policy, which slows the amount of growth in the workforce, which slows growth and is modestly inflationary. And then you look at the fiscal policy, and we got some data since, some data since we last talked. They mentioned they announced their budget a week ago, and that has a meaningful expenditure cut to everything but the military and border security, and in aggregate is a meaningful budget cut, about $169 billion, if I'm not mistaken. And there also was news of this week on the progress on the reconciliation bill, which just establishes what gets paid now, but also in the future on mandatory. And the Senate is now, after hemming and hawing, is now actually more aggressive than the House on Medicaid cuts, which are meaningfully anti-growth. And the president is now willing to, potentially, willing to negotiate a higher tax on people who earn $2.5 million or more in income to pay for some of this. The tariff revenues can pay for some of the other tax cuts that are being proposed. But the expenditure side is setting up to be, if all this gets passed, the biggest fiscal tightening in our lifetimes. And so that's not good for growth, and it favors bonds over stocks. It is also disinflationary. And so when you add up what is, forget the daily noise associated with tariffs, when you add up what tariffs will be, if you add up an administration that is aggressively pursuing expenditure cuts and a smaller government footprint, you end up with something that is solidly anti-growth and favors bonds over stocks in a big, big way.
Yeah. So let's discuss what you think is a reasonable valuation for equities in that case. Because even if you take the S&P multiples for 2026 or the earnings for 2026, what is a reasonable multiple for next year once, let's say, that all the tariffs have been settled and all the deals have been done, and the UK benchmark of 10% is a reasonable benchmark. And once you've thrown, sort of everything in there, even if the slowdown is very modest, what should the multiple be? Where should we be trading in stocks? What's a cheap level, or not even a cheap level, but a reasonable level to think that the S&P can go down to?
So let's kick that around. I think the first thing is that forward multiples, the next 12 months of EPS. Listen, last month's earnings, the earnings we just got, NVIDIA is still ahead of us, but the earnings were okay as we expected because the economy was still okay in the first quarter. The guidance was softer, and that has resulted in a forward earnings expectations dropping from 275 to $275 per S&P to 270. Now that is still a year-over-year growth of 9%. That to me can't make. I mean, it can, but it seems.
Well, it never does. It's always revised lower, right?
Right. I think it's a very aggressive starting point, but let's use that. So if you take 270 and you put a sort of slow down multiple of 18 on it, you get, what do you get? You get
4,900-ish.
4860, yeah, which was the lows for the equity market. That's that's not a recession multiple. And that's a very aggressive forward earnings in a slowdown. If you keep today's multiple, which if I'm not mistaken is around 21.1, and you apply it to earnings that grow a little bit but don't grow a lot, maybe to instead of 270 to 255, you're still talking about the equity market being in the around 5,300. And that's with the same multiple and just earnings growing slightly less than forecast. So when I look at that, fair value for equities is somewhere between 4,900 and 5,300. And I think we end up there before this is all is said and done.
And this is even without without a recession, because if we have a recession, you're likely to get 16 multiple on 250.
Yeah. I mean, that's 4,000. That's sort of a recession level.
Yeah. So, and that really explains why we are at 10% allocation in equities.
What about the upside? If everyone, you and I see this, we're just guys. We have some experience, but what about the upside? Why are stocks at 5,700?
Yeah, I keep on asking myself that. And really, the answer would have to be that the market is betting that the Trump administration will just roll back the overwhelming majority of their policies, and not just on tariffs. And I just can't see that. I just can't see that a guy who's just got in with a very strong mandate and will completely reverse the center point of his policies. I just don't see why he would do that without
I
the
think there's a
market forcing him to do
right,
that.
right. 5,700. He's got no pressure to reverse.
Absolutely, absolutely not.
4,500, 4,000. He's got quite a bit of pressure to reverse. And so my view has always been, why don't you get the market to 4,500, reverse, and run the economy into the midterms in recovery mode instead of teetering on the brink of a slowdown. But, anyway, that doesn't answer the question. I guess the answer to the question is, Nick said it. Fiscal reverse is what it will take for equities to deliver above cash returns in 2025. This is what we've said from the beginning. This remains our view. It just doesn't make sense. But animal spirits definitely impact markets, and we've had a V-shaped bottom from the Liberation Day lows, and that's created some animal spirits, which can, for me is an opportunity. For us, it's an opportunity. We're low in equities because of it, but I have no confidence that it's without the reversal of the Trump agenda.
And the other point might be that liquidity is still quite high. And you can see that probably in the price of Bitcoin, because you have had a significant appreciation of Bitcoin in the past month, let's say, approximately 20%. I mean, we bought it at 83, 84,000, and now it's 103,000. So that's 20%. And it could be very well that people who have liquidity, who have money, are saying to themselves, I don't like the valuation of equities. I certainly think that long duration bonds are risky here or will not make a lot of money. What's left? Do I buy gold at 3,300? Well, it's already appreciated well over 20%. What hasn't appreciated this year? Bitcoin was down 20%. I'll buy Bitcoin. And now Bitcoin is basically unchanged on the year. So that could be what is happening, that people, instead of buying equities, instead of buying bonds, instead of buying gold at these levels, have piled in on these alternative assets that they don't know much about, but they see their word down on the year and therefore let's buy some of that. So that could be the situation very easily, but I really would not go leveraged in any direction here, unless I see some really good valuations on equities. And I don't think we will see that for quite some time. I mean, are you really negative for the next, say, month, Andy? Can you see our targets, not targets, but our levels that we've just discussed reached in the next month or so that we can go in there with full confidence that these are reasonable valuations and let's buy, let's say, a 50, 60% allocation to stocks? Can you see that?
I would say I could see 5,300. I can't see 4,800, but anything's possible, obviously. At 5,300, would I want to go all in on equities? No, but I'd want to start allocating back to a more normal level. And I think there's a fairly high probability we end the month of June around 5,300, with possibly a journey lower, but unlikely to be higher than where we are today without that policy reversal.
Yeah. Excellent. I hope we have given you an insight into our thinking and when we will be adjusting our portfolio. And that time is just not now, right?
That's correct.
I'll talk about it more in my segment, but in the meantime, have a lovely weekend. Speak to you next week.
You as well.